Thanks for joining us for the executive series. Today I'm talking to Jacob Mitchell, who is the Chief Investment Officer of the Antipodes Global Investment Company. Jacob, good to talk to you.
Thanks, Tom. Thanks for having us here.
Not at all. Now, let's talk about the philosophy of the organisation and what distinguishes you from other investment managers.
I think there's three key areas where we think we're differentiated. Firstly, in our approach, whilst it's a value approach, we call it pragmatic value. So what's that mean? Well, it's an awareness around not just cyclical changes, because often that drives undervaluation when companies go through tough times, markets give up. And at the point of recovery, the market's still got the scars of the downturn, and that's when the asset is quite cheap. But that doesn't explain everything that happens in markets. There's also structural changes. Sometimes that business doesn't come back. And pragmatic value has an awareness around both cyclical and structural change and tries to take advantage of both when markets become irrational.
So, but fundamentally, I suppose you are a value investor at the end of the day, but you're using other parameters to validate the argument.
That's right. So, a second part of that is, we use a lot of quant in our approach. We are stock pickers, and everyone in the team has an area of expertise, but we also think quant has a big role to play. And thirdly, portfolio construction, it's not an afterthought. It's not sort of this thing that happens, this magic that happens at the end. It permeates the process, and ultimately the portfolio is owned by the entire investment team, not just the portfolio manager.
And there's also, importantly, the global aspect to the reach of the philosophy.
Yeah, we approach markets from a global perspective. We disaggregate global markets between sectors that are dominated by multinationals, sectors that are truly global, where companies compete globally, and then domestic sectors where you also need an understanding of what's happening at the country level. For an example, to understand Microsoft, you understand global technology trends. To understand Bank of America, you need to understand what's going on in the American economy. So it's a relatively unique way, I think, of approaching markets.
Indeed. So on that front, how do you actually execute the strategy once it's been arrived at?
Good question. We put a lot of emphasis through the experience and also the quant in starting broad before ending up deep, and we really test our ideas to make sure that the application of the team resource. Our scarce resource are our analysts, and every analyst has to justify to the rest of the team why they're working on a project. Why do we think there is a margin of safety? Why do we think there's multiple ways of winning? And ultimately a source of non-correlated alpha for the portfolio. So those three tests, and then if it passes those tests, then we do the deep dive and we talk to the company, we talk to other competitors. We might use industry experts. We do a lot of overseas travel, and ultimately we'll end up with a research report, and then that's debated at a stock meeting, and ultimately that debate will be around whether the idea has the merits that we thought it did at the beginning, and then what role it has in the portfolio.
Indeed. So when you look at the global investment landscape at the moment, there's a lot going on in terms of what you're mentioning before, structural change. We're at the point of the American economy being reflated with interest rates rising. What are you actually focusing on, and what are some of the interesting examples that have come out of that?
Yeah, structural change is one of those, and disruption, potentially the most overused word in the investment lexicon at the moment, but it's real. We see it locally here. Amazon's big, all the headlines around launching here, and we see often though that the excitement around those obvious disruptive themes means that there's very little margin of safety, unless you're quite early in the process of perceiving those changes. What we're finding is that often companies that were strong incumbent companies have actually become irrationally cheap because of fears around disruption. So I think a great example of that is Cisco. It's one of our top 10 holdings. Other stocks we have in that area are Microsoft, NetApp, and that's a cluster of, we would see, correlated alpha. And we're always very conscious of not having too much similarity in the portfolio. But if we're less than 15% across a group of stocks, we're okay. We feel comfortable about that. But Cisco is just, I think, very representative of our approach. It's fears around the likes of what Amazon are doing through AWS, where they're internalising a lot of the network complexity. And the question is, how is Cisco responding in a competitive sense? Because it's still for Cisco to lose. I mean, it's a dominant business. Yep. And they are. Their offering is evolving to the new paradigm, which is software-defined networking. They're partnering with sensible customers. They still are the default go-to enterprise networking solution. And security is a big part of their business, and I think the market is missing the fact that Cisco has become the world's largest cybersecurity company. So we see multiple ways of winning and a huge margin of safety because the stock's on a P of 13, and it has the sort of profitability, quality that investors in today's markets are seeking, and they're willing to pay much, much higher multiples for. So it's got a style characteristic that's in favour, but you can buy it on a value approach rather than a momentum approach, which is the way that we use quant. Yeah.
Indeed. So obviously, technology is a very important space to be looking at the moment.
Yeah, technology, a lot of change happening. But we're not, our approach is, if we look at some of the big obvious winners, we think some of those stocks, they probably haven't become irrationally expensive as they did in the tech bubble in the year 2000. But you want to look beyond the obvious winners, I think. An example is Baidu. We own Baidu in the portfolios because there has been a temporary slowdown in their business because of changes in regulation in China. Yep. But that's resulted in a massive margin of safety. If you look at the valuation of Baidu versus Google, it's on a much, much lower multiple of sales, with as much runway in terms of growth. And once those issues unwind, we think the PE, the headline PE looks high, but if you take out some of the noise in the numbers, it's actually very, very low for what the business is.
Indeed. Now, you make a good reference there to noise because really since the US election last year, the volatility in the markets has been quite distracting. What's your view of the global market picture at the moment?
If you did a quick tour around the globe, if you broke markets down between domestic and global sectors, we think a lot of that Trump enthusiasm was actually well reflected in the domestic part of North America. Those valuations are very high versus their history and versus the rest of the world. So, if you do a like-for-like analysis between a European bank and a US bank, a US airline and a European airline, a US telco like Verizon versus a European telco like Telecom Italia.
Yep.
In each of those examples, the European alternative will be a third to a half cheaper. And because the market in North America believes that all of the Trump reform tax cut agenda is almost signed, sealed, and delivered, whereas you've got the opposite in Europe, where we're constantly jumping at shadows in regards to political risks, and hence we have more exposure to European domestics than we have to US domestics. Then when you look at global companies, we still think in tech in the US there are opportunities, so we have exposure there. And then if you go to Asia, we like the exporters in Korea and Japan. They're still quite cheap. And in Korea, you've probably got an added reform potential around the dominance of the family starting to unwind and seeing better payouts and better governance generally in Japan and Korea, which is not really an option elsewhere in the world. I mean, elsewhere in the world, you've had aggressive buybacks, often funded by debt.
Yep.
You've got the opposite in Japan and Korea. You've got companies that have got too much cash that need pressure, and that pressure is starting to come from shareholders for better governance. And it's not reflected. It's a massive way you can potentially win there, which is not reflected in valuations. And then if you look at domestic parts of the other emerging markets, we definitely want to be exposed to the domestic part of China. I mean, you still have value there. To take just one like bellwether stock like China Mobile.
Yep.
Its EBITDA multiple is, once again, it's roughly half of what you're paying in North America for Verizon, and you've got optionality around better capital management. I mean, it may take some time to come through, but the Chinese are aware that their listed SOEs are ultimately a part of the national balance sheet.
Yep.
So I think it's logical that over time you actually see better governance outcomes.
Jacob, good talking to you. Look forward to following the story with you over the course of coming months and years. Thanks for your time.
Great. Thanks, Tom. Cheers.
Thanks for joining us for the Executive Series.